Hey, what's up, guys? It's Larry, the mortgage guy, and we're going to talk about the differences between pre qualification, pre approval, and TBD or to be determined fully underwritten pre approvals. So, again, we're going to answer the question: what is the difference between a pre qualification, pre approval, and TBD fully underwritten pre approval? Okay. Uh, so a pre-qualification, which is what you probably have experienced before already if you were to apply for a home or a mortgage, is you submitting your information via an application of some sort, maybe over the phone, maybe in person, maybe you fill out some sort of online form, which is how I typically do it. And you're kind of, I guess not guessing, but you whatever comes to mind. How much do you make a year? How much do you make a month? Where do you live? When did you start living there? How much money you have in the bank? You probably don't know the exact set, so you kind of estimate it. So let's say you have $30,000 in the bank. Well, actually 29,255. You might just put $30,000 or something like that. Basically, stated information, right, on your financial profile. Then the loan officer pulls your credit using a hard inquiry, right? Now, I've heard the term soft pull versus a hard pull. In reality, there's no such thing as a soft pull. It's a pull or a non pull, an inquiry or a non inquiry, right? What I mean by that is, yes, you can have your credit looked at in a soft way where they look at your scores, but they don't have all the information they need in order to actually qualify you, because another thing that we're looking for are your debts, right? How much you owe on certain debts and collections and any other liabilities that may be reporting on your credit report. Okay, so that's why I consider it a hard inquiry. And the reason why there's a difference between a hard inquiry and a soft inquiry or soft pull is when you are asking for someone's credit profile, you're asking the bureaus who carry this information for information on that client. So they know that you are inquiring on behalf of a certain client, their information. And that's why it's called an inquiry. Most inquiries or most soft credit pulls or self credit reports are not inquiries because you're asking yourself. You're paying some third party to look at your credit report, and it's not really an inquiry. It's you looking at your credit report, but it's you, the consumer, not someone who's thinking about lending. It's when I ask for your credit information is when it's an inquiry. Okay. So that's why the hard soft thing is kind of a weird way of looking at it. I guess it's a way to simplify things, but basically it's an inquiry or it's a non-inquiry. Okay. But that's required for pre-qualification. And we normally take the information that you give us via the application and the credit report, whatever the bureaus report on your debts and liabilities, and we sort of structure the information and see if there's room for a mortgage. And if there is, how much of a mortgage? And we run it through the automated underwriting system, or AUS. Okay. Now, the way AUS works, probably most people can't really explain it to you. So I'm going to give you sort of a theory or like my dumbed down version of the way I look at AUS. I look at it as an automated robot mortgage god that knows all the guidelines, knows what's required, what's possible, what's not possible. They probably know about all the different mortgages that are being ran through the system, and they use algorithms and certain objectives and stipulations and qualifications to see if you, based on the information that's provided, can possibly buy a house, and if you can, how much house can you buy? Okay. Now, it's only as good as the information you put in. Okay. And this is where the pre-qualification and pre-approval differentiate. Okay. Pre-qualification, usually it's information that's just gathered verbally, or you filled it in. There's no verification involved. It's not like I looked at your pay stubs or your bank statements or talked to your boss or anything like that. You just told me what you think you have going on, and I plug that in. And then I add that with your credit report, and AUS just tells me whatever. Okay. Now, the way I look at this is like an algebraic equation, right? There's a lot of variables, and we're kind of putting all the numbers together and coming out with some sort of result. Okay. So, again, the way I look at pre-qualification, it's only as good as information you put in. So why would that be something I'm harping on or emphasizing? Well, some people don't really know how much they make, right? Especially self-employed people who generate income as a business, as a contractor. They're not W-2s, they're 1099s or whatever, LLCs, whatever. And they think they know how much they make, but based on their tax returns, it might be a different number. Now, the reason I use air quotes is because from my experience, 9 out of 10 times, they don't know the actual number, right? An underwriter will actually give you the actual final number. We, as loan officers, try to formulate or do the homework or math and try to and hope that it is what the underwriter thinks is correct. But sometimes the underwriters is going to change it, sometimes in our favor, sometimes not in our favor. Okay. So that's where the state information can become risky. Okay. And I'm kind of giving you the pros and cons at the same time because we're already on the subject of a pre-qualification and why it's different from a pre-approval or a TBD fully underwritten pre-approval. Okay. So again, it's stated information. It's based on what you tell us, what you're basically through memory or guessing what you think the numbers are, and then coupled with your credit report and some other pieces of information, and we run it through the automated underwriting system. And the automated underwriting system, for the most part, has to give us an approval result, right? There's a different term for it, but you don't need to know that. Now, if it doesn't give us an approval result, it might give us a different result that might still be workable, but that's when the pre-approval may be required. Like we need more documents, we need more information. There's not enough stated information and not enough information on the credit report to have a confident approval. Okay, so that's what a pre-qualification is. Okay, so pre-approval. As you can see, the difference is not very much. Verified and reviewed documents. Now, when I talk about incomes and funds, I'm talking about how much money you're making, maybe through your job, maybe through your business, maybe through your retirement, maybe through disability, maybe through child support, alimony, right? There's all sorts of income that you can be getting. You can be getting income from dividends or from I don't know. There's so many different versions of income that I've seen that documentation is going to be required for a lot of those different types of income, especially when it comes to self-employment. Okay, tax returns basically is what I'm saying. So again, the difference between pre-qualification and pre-approval, the very glaring difference is again, instead of verified and review documents on a pre-approval, we're getting stated information on a pre-qualification. So pre-qualification, we're taking your word for it. Pre-approval, we're using evidence, we're using documentation. Okay. And this is for income for the most part. Funds, I would venture to say that some loan officers may pre-approve you based on stated information about your funds, like, oh, you got $50,000 in the bank. Okay, cool. We'll take your word for it, right? But there's things that you need to be careful when it comes to stated funds versus actually documenting funds. Like for instance, let's say you have a 401k, right? Or you're going to maybe get a gift, right? Or there's just different ways that you have funds coming in. Paperwork may be required just to make sure that the funds are usable. Why would this be a question? Aren't funds funds? Well, a lot of people have tried to get pre-approved using cash, right? So they have no money in the bank. They have no money in a retirement 401k, whatever. They just have a couple of $1,000s under the mattress. And they don't tell me how much they have. They always ask me, well, how much do I need? And I'll tell them a number. And they're like, yeah, I got that. I'm like, where? It's like, yeah, it's cash. See, that's when you have to verify and review and confirm funds, right? They have to be sourced. Okay. So when I say pre-approval, on the surface level, we just need to see paperwork showing what you had. But I'm also talking about what actually can be approved, right? Like you might say, yeah, I got documented funds somewhere, right? Well, I might be like, well, I need to verify that. I need to look at it, and I need to make sure that those funds are usable. Okay. Uh, Again, example 401k. Let's just say that you have a 401k and you say, I have enough for the down payment, whatever. Well, I might still want to look at it because I might want to look at the terms of the 401k because maybe your 401k does not allow you to take money out to use as funds. So let's say you have no money in the bank and you're depending on your 401k. It's like $50,000 for closing costs, down payment, everything like that. And you have $70,000 in your 401k. And I look at it and it says maybe the terms are you can only draw half of your 401k towards an emergency or down payment. Well, half of $70,000 is $35,000. That's not enough to cover the $50,000, right? So at that point, you're not pre-approved. You don't have enough funds, right? So a pre-approval is not just seeing the funds, but also verify that the funds are usable. Like if we were to close today, we can access those funds, right? Or if it needs to be moved around, whatever, maybe you need to draw some money out of the 401k, take some time. If we need to close as soon as possible, we know the timeline and what is needed to get those funds, right? So verifying funds is not just about you have a bank statement with $50,000. We need to know where that $50,000 came from, right? So verifying documents in terms of income and funds gets a little bit deeper than just stated. Okay. Again, a hard inquiry on the credit report for scores and debts. There may be a little bit more work done on the credit report, but they should already be done at the pre-qualification stage. But maybe we need to ask a few questions about collections or disputes or student loans. I mean, there might be things on that credit report that might need some sort of documentation. Okay, maybe there's a bankruptcy or a foreclosure on the credit report. And even though in the pre-qualification stage, it's been 4 years, so you might be okay because the season period that you might have to wait is usually 3 years or less. We might need documentation to make sure that it's discharged or whatever, right? So the pre-approval might require that. So I might say on the pre-qualification, okay, well, it's been long enough. You should be fine, right? But I do recommend getting pre-approved just to make sure, we don't have any last-minute surprises. And that's when I start asking for your documentation. And once you provide it and review it looks good, then I can be like, okay, you know what? Based on this, on the details of the bankruptcy or the foreclosure, you are definitely okay. So you're pre-approved, at least on that aspect, right? And again, you're right through the underwriting system. And of course, when we do the pre-qualification, we would run it based on state information. And then once we get the documents, we will plug in the numbers more accurately. So instead of, again, $30,000 as a round number, we have 29,000, we put it all in, and then we run it through the underwriting system just to make sure the documents support a purchase, meaning it's pre-approved. Okay. So again, the difference between a pre-qualification or pre-approval, pre-qualification is stated information. We're taking your word for it. We're not asking to verify any documents. We're not asking for evidence or anything like that. We're going to take your word that you make this much. We're going to take your word that you have this much in funds. We still need the credit report, and then we bring it to the underwriting system using the variables to create the algebraic equation. Okay. Pre-approval, we're not taking your word for anything. We're verifying everything. We're getting your tax returns. We're calculating the income. We're looking at the funds, making sure that it's sourced or seasoned or whatever, coupled again with your credit report, and then we're running that through the underwriting system and getting the approval result again. Okay. Now, most important that you probably should think about if you're wondering, do I need to be pre-approved, is if you're self-employed. Like I said, self-employment, most people, I would say most in my experience, because maybe there's a majority out there that I don't know about, or a whole bunch of people out there that I've never talked to, but the majority of my people that I've talked to who are self-employed do not know their exact income amount. They don't know it. They think they know it because of whatever information they have. Maybe they're looking at their bank statements. Maybe their CPA told them something, whatever. But based on the underwriter's math and the guidelines and how we calculate self-employment, 9 times out of 10 is different from what the person thought it is. And again, it could be in our favor, but usually it's not in our favor. So what I'm saying is that self-employed people usually think they make more than what the underwriter is actually willing to give them credit for. And when it comes to you versus the underwriter is going to win, because the underwriter is ultimately the person who endorses or approves your loan and approves the funding of buying your house. So we need to adhere or accept or respect the underwriter's math. Okay. So if you as a self-employed person thinks you make this much and the underwriter says you make this much, there's no arguing with the underwriter, because the underwriter is the one who's giving you the money. So you need to accept the math of the underwriter and therefore be subject to whatever they say that you are qualified for. Okay. I've actually had people who told me the underwriter is wrong. I'm like, well, right or wrong, they're the ones who make the decisions. So even if their math is wrong, we can't do anything beyond what the underwriter says. What they say is law. Now, of course, there's exceptions. You could, maybe do the math yourself as a loan officer and argue with the underwriter. You can escalate it, yada, yada, yada. But underwriter's job is to make sure they do the math correctly. Their job is to make sure the loan is approvable. That's literally what they do for a living, 20 times a day or whatever. So to question the underwriter's math, you're probably going to be questioning you're going to be in a losing battle. Okay. There's a chance that you could win, but for the most part, you're not going to get the underwriter to disagree or get the underwriter to agree with your math if it's not the same as their math. Okay. Just saying, right? So that's the difference between pre-qualification and pre-approval. Now we're going to talk about the fully underwritten TBD pre-approval. TBD stands for to be determined. Okay. Again, verified and reviewed documentation, same as a self-employment. Same as a pre-approval. Now, there also might be a requirement of a written VOE. VOE stands for verification of employment, written. Okay, so verification of employment can be done over the phone or whatever, but for the most part, for the underwriter to be comfortable with the math and the information that's provided to see what your income actually is, they may request information confirmed by your employer, right? So when would this be useful or important or employed? When it comes to maybe overtime, right? Let's say you get a lot of overtime, right? But it's not quite the amount that we need, or the duration of it is not quite the amount that we need in order to give you credit for it. We may need to speak to your employer. And one of the questions that they ask is, does this person get overtime? Yes or no? And if they do, does it seem like it's going to continue? Right? So let's say you get overtime that might be enough to qualify, but we ask for a VOE and the employer tells us that overtime will be cut off by the end of this month. Well, because of the VOE, that overtime that you've been getting for the last 2-3 years, whatever, how long you've been getting, we cannot give you credit for because your employer literally told us that you're no longer going to be getting that overtime. Right. So that might be something that would need to be done to have a conditional approval, meaning like a fully underwritten TBD pre-approval, which is a conditional approval. Okay. So in some cases, not all cases, but in some cases, we may need a written VOE. Okay. The underwriter is calculating the approved income. When I say approved income, that means once they calculate it, that's the number. Right. Of course, there may be some exceptions. Like I said, let's say they don't get the written VOE until after the fact. Right. But let's say it's not a situation where there's overtime. It's been the same salary for the last 5 years. We have W-2s to show it. We don't need a VOE to really confirm, even though we get it still. The underwriter is pretty confident that the number is going to be the same. Then they can actually calculate what they think the income is. And that's basically final. Right? Like they've already checked it. They've already done it. They've already calculated it. So the moment that file comes back onto their desk, they're like, I already did the calculation on on income. So they move on. They might do a quick review, whatever, but there's no need for them to recalculate it. Okay. They've already done the work. Okay. So that's what I mean by a fully underwritten TBD pre-approval. The underwriter's already calculated income. Now, why am I harping on this? Because for self-employment, this is going to be key in making sure that you are qualified for exactly what you're getting, right? What I mean by that is even if the loan officer, myself, and my team calculates your self-employment income, we might do the math wrong. There's been plenty of times, and any loan officer that tells you that this doesn't happen is lying to you. But there's plenty of times where the math that we came up with is different from the math the underwriter came up with. And again, when it comes to the loan officer versus the underwriter, 9 times out of 10, the underwriter is going to win because they're the ones who endorse everything, right? That's their job, right? They're the judge, we're the attorneys, and you are the client, right? You're the defendant, whatever you want to call it, right? So we're trying to prove that you qualify, but the judge is the one who makes the final decision. Okay. So that's why self-employment is really helpful, because we might calculate incorrectly. You probably think it's a certain number, but it's wrong. The underwriter, once they figure it out, that's basically done. That's basically the number that they're going to come up with. Okay. That's the number that they're going to stick with. Okay. So that's a very big advantage to the TBD pre-approval, because that part is done. There's no need to worry about it. There's no need to question it. It is what it is. You qualify for a certain amount. If you find a house under that, great. If you can't find a house under that, well, there's nothing we can do about it. Right. But either way, that box is checked, right? We know how much you're making. The underwriter has already calculated it, and they're confident about it, and they can move on. Again, it's good because there's no need to worry about it anymore, and that part of the underwriting system is done. Therefore, no need to be done again when we're under contract. Okay. Again, you need the hard inquiry for credit report and credit scores, which the underwriter will review, right? And that's the part that I really like, and that's kind of adding to the rest of the features of a TBD pre-approval is ran through AUS using the underwriter's information, using the underwriter's math on the approved income, using the underwriter's review of the credit report. Okay, and based on all that, they will conditionally approve you, just like when you're under contract and you're going through the processing, whatever, and you go to underwriting and you're conditionally approved. And the conditions may be another bank statement, another pay stub, whatever, right? But you're conditionally approved. What that means is that you look good on paper so far. There's nothing here that's standing in the way of you buying this house. Now, of course, if we ask for something and it's not delivered or it's different from what is expected, then that causes problems. But if it's going to be business as usual, like I said, let's say you have a job where you've been paid the same thing for the last 5 years, and they just need a most updated pay stub because it's been 45 days since they collected a pay stub, right? So they just need the most recent one. It shows exactly what you're going to make anyways that we've seen consistently the last couple of weeks. So it's an easy condition. It's just an updated condition because the pay stubs that we got from October, or actually, let's say right now is November, the pay stubs we got from September are no longer valid. So we need the ones from October and November or whatever, right? So conditional approval is basically where we're all trying to get to when we're under contract. Well, what I'm saying is that with the TBD fully underwritten pre-approval, you can get to that point before you're under contract. You can be literally fully underwritten and conditionally approved TBD, to be determined, based on the property and the appraisal. So what I mean by that is a fully underwritten TBD pre-approval is basically getting you fully underwritten to the fullest extent that you can be. Verifying income, verifying funds, looking at your credit report, everything. And it's the only thing that's missing, the conditions, is the property and the appraisal, and maybe an updated pay stub or whatever, right? It's literally the closest you can get to being done with a loan minus the property, because obviously you can't close a loan without a home, right? So the TBD is to be determined based on the address or the property or whatever, right? So again, the difference between a pre-qualification, a pre-approval, and a fully underwritten TBD pre-approval is that a pre-qualification is based on stated information for the most part. We're taking your word for it, whatever you guessed or whatever comes to memory. Pre-approval, we verify the documents as a loan officer, not the underwriters, but the loan officer. We think everything looks good. We think the math looks right on the income, and we believe you have a job. based on what you're saying, right? And based on your pay stubs, whatever. And we believe that, you're not going to go spend that money, at a casino, whatever, right? Fully underwritten TBD pre-approval. We verify everything. We act as if you're under contract. We process you. So you go through processing, you go through underwriting. The underwriter tells us, I approve this person, or I conditionally approve this person, or they're pre-approved. The underwriter writes a letter. Okay. And there's no higher law than that when it comes to the approval, is the underwriter. Okay. Except for maybe the underwriter's manager or whatever, right? So basically, we're doing the work ahead of schedule, right? We're doing the work ahead of, like, we're putting, from my perspective, people put the cart before the horse. Well, we're putting the horse before the cart by having the underwriter look at it. Okay, that's basically what we're doing. Okay. So what's the pros of a TBD pre-approval? Well, you can save weeks in underwriting while under contract. You're definitely going to close faster and earlier because you're done. Like, the buyer portion of the processing and underwriting is done. Now we're just worried about the property portion of the processing and underwriting. The buyer portion is done, right? Which 9 times out of 10, that's what causes the most delays, right? Because the lack of speediness or urgency from the borrower, or maybe there's something that needs to be taken care of. Maybe there's something missing. Maybe we need to get documentation from the IRS, whatever, right? That's all taken care of. That's done. So the only thing we have to worry about is the appraisal and how long that takes. But the quicker the appraisal is done, the quicker we can close, right? So there's only one variable that's holding us up, which is the property and the appraisal, inspections, whatever, right? But the rest of this stuff that can create variables is already taken care of. So you're definitely going to close faster and, of course, ultimately earlier. Okay. You're confident when you're making offers, right? You are basically a cash buyer. Your approval to buy this house is pretty much, for lack of description, guaranteed. Of course, nothing guaranteed because you might lose your job or whatever. But for the most part, you can make an offer knowing that you're going to qualify and close in this house, right? And that speaks volume in a multiple offer situation when you have other offers who are just pre-approved or pre-qualified, and you're like, listen, I've already been pre-approved by an underwriter. I'm conditionally approved, so there's no surprises, right? Here's a letter from the underwriter, right? And we can close early, right? You want to close in 30 days? I can close in 25. I can close in 20. I can close in probably 15. Okay. And again, it's because there's not going to be any last minute surprises in underwriting. That's why you're confident, right? And you can actually tell these sellers that, like, as the real estate agent talking to the seller's agent, or however, whoever's communicating, you can be like, listen, my clients are fully underwritten, TBD pre-approved, TBD based on the property and the appraisal. So we're done. Now it's just a matter of you guys and your property. Is it approvable? Does it qualify? Right. And because of that, there's a potential of saving time and money, because you don't have to pay for extensions for locks. There's no need to rush an appraisal. Well, I guess you can rush an appraisal if you want, because you might close faster, but there's no need to pay extra for anything. Right. And if you plan for a 30-day move, well, now you can save it for just a 20-day move or a 15-day move. You can save money on electricity or whatever. Right. So there's a lot of room to save money if you can close with more confidence and close faster and earlier. And ultimately, peace of mind for everyone involved, including the loan officer. Right. But peace of mind for yourself. I mean, I think people have turned this process of buying a home into a really stressful, urgent, has to be done now. Everything's last minute. Everyone's scrambling. I have so many different things. They turn it into a very stressful, not enjoyable process. I think with a TBD approval, you can make it very enjoyable by making it stress-free, right? You're done ahead of schedule. You can take your time. You can relax. You can schedule however you want. Right? You've given yourself 30 days to do this task, and you're going to get it done in 20 days. So you have an extra 10 days to do whatever you want. Right? So there's a little bit of flexibility. Okay. So there's a lot of pros when it comes to a TBD pre-approval. Now, what's the con? Well, the con is the work is going to be done before contract instead of after. So you have to go to work not more, just earlier, right? So let's say there's 100 hours of work that needs to be done. 100 hours is a ridiculous number, but I'm just using 100 to make it simple. So let's say there's 100 hours to be done in terms of buying a house. Well, instead of doing like 10 of it before contract and 90 of it after contract, you're doing 45 of it before contract, and then you're going to do 45, 50 of it before contract, and 50 of it after the contract, right? So you're still doing the same amount of work, just you're doing it earlier. And because you're doing it earlier, it's less stress, right? So that's not really a con. You're just kind of shifting around your effort, right? I've had people give me pushbacks like, why are you asking me for so much stuff? I'm like, because I want to make your life easier when you get a contract, right? I'm asking you to get pre-approved and fully underwritten so that whenever you get a contract, there's nothing left for you to do. You can just relax and chill and just look at the updates emails as they come in, because you're already done. Your part of the job is done. We will need that pay stub eventually, but you don't have to worry about that for the next 15, 20 days. Everything else is taken care of. Okay. So I guess you can call that a con, right? More work up front, but less work at the end. So it balances out, right? And the last con is actually for us, the mortgage company, the loan officer, right? The team. The underwriter's time and work can potentially be for free. What I mean by that is, why do processors and underwriters go to work when we have a contract? Because that's guaranteed money as long as we close the deal, right? That's an actual bid that's been accepted, right? We have people who've hired us, so we're going to go to work so we get paid. Well, when we do a TBD pre-approval, there's no contract yet, so there's no guarantee, right? You might decide never to look at houses. You might not find any houses that you want, right? There's no A, B, or C situation. It's more like A, B. Maybe there's a C, right? So my team, myself, and the underwriters are going to be working for free if we don't get a contract. They still get paid. I don't get paid as a loan officer because I don't get paid unless we close, but the underwriters and the processors still get paid. So there's a chance of a loss when we do TBD pre-approvals for the branch, for the company. But we're willing to do that. Why? Because it makes sense. We're willing to do that because it gives us a competitive advantage. It gives us a competitive edge. We can close faster. We're less stressed. We're going to do the work anyways. And we're basically putting our faith and confidence that you as a client are going to honor the work that we did and go through and buy a house and stick with us, not abandon us, right? So anyways, that's basically what a TBD pre-approval is versus a pre-approval versus a pre-qualification. Hopefully that makes a lot of sense. Obviously, I'm bringing this up because we do TBD pre-approvals, especially for self-employed people. If your lender does not do TBD pre-approvals, demand it. If they don't provide it, let me know. If I'm licensed in your state or if my branch is licensed in your state, we'll do their TBD pre-approvals for you and show you why it's the best way to buy a house if you are a client or a real estate agent. Okay. Any questions? All right. I will take that as a no. Really appreciate it. If you have any questions, give me a call or text me, email anytime. Larry Lee, 832-606-2193. Larry openmortgage.com, or you can go to larrylee.com, or you can Google Larry the Mortgage Guy, or you can actually find me on Linktree as well, Linktree/Larry Lee. Right. Really appreciate it. Yeah, that's it. I'll really appreciate it. And I will see you guys next time. This is Larry the Mortgage Guy. I'm out.